Listen, here are 8 IRS changes that could impact your taxes in 2026 and may even put more money back into your pocket. And if you've been tapping into the tax knowledge that I've been dropping here lately, you got to understand that you want to make sure you have all of your ducks in a row before you file your taxes. And don't just rush to file your taxes just because somebody has pressured into you into go ahead and filing. You want to make sure that you do your due diligence on what you actually may be able to deduct, because the deductions can increase your tax refund. And the deductions in most cases is based on the activities that you conducted last year. What do I mean? Many people don't know this, but they may qualify for tons of tax deductions that can equate to over $10,000 in tax deductions off of stuff you were already doing anyway, especially if you're in the gig economy and you do things associated with making deliveries, driving, DoorDash, Uber, roadie, you name it. Those things qualify you for tons of tax deductions in the area of mileage, your cell phone bill, etc. In addition to that, the fact that you're on social media, if you're posting content with the intent to make money, then it's a good chance that you qualify for tax deductions. Things like your phone bill, your internet, sometimes your meals, your travel, your miles, depending on how you incorporate everything you do into your content or to your business. If it costs you money, then it can be tax deductible. And that's not something you want to sleep on, because many people have already spent money to do things that they were going to record and they knew they were going to post it as content. And now that could position you to make the things that you did last year tax deductible. And if you're thinking about travel, if you're thinking about the things that you may have done, that can equate to 5 figures or better in tax deduction. So hopefully that makes sense. Now, here's some changes that took place based on adjustments to inflation that could help your tax refund in some way, shape, form, fashion. So let's look at this list, and I want to know down below which one is one that you're excited about that could benefit you. And some of them come with an added benefit that's not so easy to recognize with the naked eye. You got to look a little deeper to understand the depth of it, and I'll tell you what I mean. So the IRS is basically rolling out a new set of inflation adjustments and policy shifts for 2026, which raises deduction, expanding savings limits, and adjusting certain retirement related provisions and retiring direct files. So it's some things that shifting that you may not like, but some things you may actually like. So let's get into it. Number one, standard deduction increases for all filing statuses. The standard deduction is a fixed amount you can subtract from your income to reduce how much of it is taxed. The amount you qualify for depends on your filing status. So that being said, for tax year 2026, which will be filed in 2027, the standard deduction rises to $32,200 for married couples filing jointly. Single taxpayers and married individuals filing separately will see a deduction of $16,100, and heads of household will receive $24,150. For context, the One Big Beautiful Bill added an extra 5% to the inflation adjusted standard deduction for tax year 2025. The table below shows how the 2025 values change and how they compare with 2026. So, of course, some things have changed that will affect how you operate in this year, but it's some things that change that can benefit you based on what you did last year. So the 2025 standard deduction before the One Big Beautiful Bill, then you can see on the left, 2025 standard deduction after the Big Beautiful Bill, you can see in the middle, and then 2026 is on the far right. So as you can see, the standard deduction went up after the Big Beautiful Bill for both years, whether you're single, married, filing separately, or head of household. Now, what you can't see with this, and this is what I mean, some things are not just as obvious to the naked eye. When the standard deduction changes, and this is not financial advice, but if you understand what I'm about to say and you pick up what I'm about to put down, this can help you tremendously, and it can at least position you to ask the right questions to your tax professional so you can benefit from this. So let's say, for example, you have a business. You're a home-based business owner, or you do business from the comforts of your home, comforts of your phone, or even if you have a brick and mortar, and you have a child that's old enough to help in some way, shape, form, fashion, whether they're helping with keeping the office clean, the area clean, they're helping you with sending off and mailing letters and packaging letters, depending on your business model, or packaging product to ship out, or they're helping you with your content, and you pay them a certain amount, you can pay them up to the standard deduction in some cases, And that can be pretty significant. Why is that important? Because if you are already going to spend money on them anyway, done the right way, you can pay them up to that threshold. And now that money can go towards them, but also serves as a tax deduction to you without them having to pay any typical taxes that they would have to pay from getting a job. That's very important. But get you with your tax professional. Again, this is not financial advice. I just want to let you know that there's certain things that you may not realize. Additional deductions increase for older taxpayers. So those 65 and older blind will qualify for a larger standard deduction for 2026. That means an extra $2,000 for single filers and heads of household, or $1,600 for each qualifying spouse on a joint return. And basically for taxpayers both 65 plus, the amounts doubles to $4,000 for an individual and $3,200 per qualifying spouse on a joint return. On top of that, the One Big Beautiful Bill created a new deduction for older taxpayers effective for 2025 through 2028. So if you're 65 or older at the end of 2025, you may qualify for an additional federal income tax deduction up to $6,000 if you file an individual return, or up to $12,000 if both spouses are 65 or over and you jointly file. So however this new deduction phases out for taxpayers with modified adjusted gross income over $75,000, $150,000 for joint filers. So it depends on your income. So get in where you fit in there. Number 3, new inflation adjusted tax brackets roll out. So each year the IRS adjusts the nation's tax brackets upwards to account for the impact of inflation. Well, this also helps to prevent bracket creep from nominal wage increases. For tax year 2026, the highest tax rate remains 37% for individual single taxpayers with incomes greater than $640,000. So they're in the 37% tax bracket. But again, if you got tax deductions and you understand how to do certain things, you can lower that tax bracket and lower your tax liability. And this number is $768,000 for married couples filing jointly. The other rates are 35% for incomes over $250,000 and over $500,000 for married couples, 32% for incomes over $200,000 for married couples. And you can look at it. You can just see the numbers and how they adjust based on your tax bracket. So the less you make, the lower the tax bracket you're in. But I'm here to tell you, if you have tax deductions, you can lower your tax liability anyway. So even if you make over $250,000, even if you make over $500,000, you can position yourself to get under the 22% tax bracket if done correctly. Now, you may not want to get it that low because you may consider that to be a red flag, and then it varies depending on what you're trying to do based on your income, depending on what type of loans you may want to qualify for. But tax deductions are definitely a cheat code. But the lowest rate is 10% for single individuals with incomes that are $12,400 or less, $24,800 for married couples filing jointly. And again, tax deductions have allowed certain people to get to the lowest rate of 10% as well. Now, let's talk about number 4. Contribution limits rise for 401ks, IRAs, and the health savings account. So basically, they allow you to put in more money. You can look at the details. I won't read it verbatim, but the contribution allows you to put in more money towards your 401ks, your IRAs, and the HSA. So HSA savers will also see limits rise, with annual limits rising $4,400 for individuals with self-only coverage on a high deductible health plan, and $8,750 for those with family coverage. So that could be to your benefit. Number 5, Roth only rules kick in for catch-up contribution. So high income taxpayer ages 50 and over will see changes to how they can make catch-up contribution. This basically allows people who want to catch up and put more money in their future retirement to pay more, put more in. Individuals basically who earn more than $150,000 for 2025 can make any catch-up contributions on Roth basis only. Contributing to a pre-tax account will no longer be an option. So now they're changing that. They're saying that contributing to a pre-tax account would no longer be an option. So some things have changed about that. Look deeper into the details because there's always some other avenues of things that you can do if need be. Now, new deductions for tipped workers. This can help a lot of people because restaurant servers, bartenders, hotel staff, salon workers, rideshare drivers, dozens of other service workers that receive tips will be able to deduct up to $25,000 in qualified tips each year. From the 2025 to 2028, the IRS defines qualified tips as voluntary customer tips reported to your employer or received directly, and the deduction can be claimed whether or not you Itemized. The benefit phases out for higher earners beginning at $150,000 in modified adjustment income and $300,000 for joint filers. Eligibility is based on the IRS issued list of occupations that regularly receive tips and will be finalized in upcoming regulations. So certain things that are tweaking and shifting about that, but just understanding that you can minimize your tax liability based on the tips that you receive. They're not going to treat it as typical income. Number 7, new deduction for car loan interest. Taxpayers who purchased a new vehicle with an auto loan in 2025 may be able to deduct up to $10,000 in interest paid as long as the car was assembled in the U.S. and weighs under 14,000 pounds. They want to incentivize those who purchase U.S. vehicles, and the deduction phases out if the taxpayer's MAGI exceeds 100,000, 200,000 for joint filers, and disappears at 150,000, 250,000 for joint filers. So some of these are very detailed, but depending on your situation, you could benefit greatly, but definitely get with your tax pro. I just want you to know that it's some opportunity here if you take advantage of it. But if you just rush and file, then you do yourself a disservice. And number 8, IRS direct file ends after the 2025 tax season. So the IRS will discontinue its free direct file program for 2026. The program enabled eligible taxpayers in 24 states to file their federal taxes free with the IRS. However, the Treasury Department suggested that the IRS will focus its efforts on its other free programs, including Free File, a partnership with a group of commercial tax software companies. So they're still allowing it, but it's just going through certain companies, and those certain companies have the ability to yay or nay certain type of filers that they'll accept. So let me know, which one of these do you find most favorable? I like a few of them. I like the ability to increase standard deduction and people contributing more to their investment accounts. But you let me know which one is one that you prefer the most. But the most important thing I want you to gather is don't rush to file your taxes if you have not calculated what your expenses could have been for the previous year. If you've been doing anything on the side to make money, such as doing something that's in the gig economy, e-commerce, social media content, trying to make a profit, because those things that you spend money on in order to do whatever it is necessary to create another stream of income can be tax deductible up to 100%. Mr. Smith signing out. Salute.